Hello, we are Team SIMonics, and our presentation today is meant to help you, the Board of Directors, to determine whether you should reaffirm your commitment to our venture. Our agenda begins with a financial overview so the Board may see our financial results. We will then discuss how we obtained our results through our value discipline and strategy. In addition, we will address some of the risks of our venture and how to offset those risks in the future. We will then transition into a presentation of our product mix and market share. We will begin with an overview of our financial situation. SIMonics was given €8 million in venture funds and access to €12 million in loans guaranteed by the corporation. We made an initial investment of €1 million to increase our production capacity to 25,000 units per day and invested another €375,000 to decrease our setup time to 6 hours. These investments prepared our company to meet customer demand at a reasonable cost. This is the summary of financial statements. It is a comparison of our company's performance against 8 other companies. SIMonics was the #1 ranked company over 6 quarters. You will notice that we have the top income, high sales, #1 profitability, and marketing of 4.7% of sales, which was half the 8.2% of the second ranked competitor. In addition, we had the second lowest gross and net margins, which reflects our ability to keep the cost of goods sold and other costs competitively low. And we had the second lowest debt to equity ratio. The bottom line is that SIMonics has proven to be the top company among its competitors and is returning the highest amount of profitability to our shareholders, as evidenced by a return on equity of 43%. In order to provide the board with better detail into our financials, we have provided a profit and loss that includes our 8 competitors. This profit and loss shows that we have efficiently used our warehouse resources and have the lowest warehousing expense. We have invested in appropriate manufacturing setup improvements to meet our customer needs, and SIMonics management gets bottom line results. Our balance sheet shows that by the end of the 6th quarter, we had €1.3 million of cash available on hand. Our goal has been to keep €1.5 million on hand to cover short-term cash flow and operational needs. This amount keeps our cash conservatively productive at all times. At the end of the 6th quarter, we also carried finished goods and raw materials in inventory. Current inventory levels will allow us to immediately run production and make sales once the 7th quarter starts. One key to containing costs is having a reasonable debt level. By keeping our bank loan balance low, we maintain our AAA credit rating and can borrow funds as appropriate at a low interest rate for short-term cash flow or investment needs. Our value discipline and strategy has been one of operational excellence. We command an operational advantage over our competitors through forecasting and sales, efficient production, cost containment, and targeted marketing and pricing. Forecasting of sales is the core from which our operational strategy grows. For example, correctly forecasting the sales keeps inventory from exceeding warehouse space. In the 6th quarter, SIMonics forecasted production of 730,000 units and sold 603,828. By dividing the units sold by the number of units forecasted, SIMonics had a forecasting accuracy of 83%. In order to further understand our forecast and sales, we will next look at the production efficiency, cost containment, and marketing and pricing strategy in detail. SIMonics has been able to maintain continuous production during the 6 quarters as evidenced by the straight line of production in the graph. We have done this by forecasting 50,000 unit production runs every 2 to 3 days and scheduling no more than 2 to 3 production runs at any one time. Our strategy is not only efficient, but also allows us to make changes in production depending on market demand for our products. In addition, we produce 88% of the time, which allows for an average production of 22,100 boxes a day and creates enough product to meet the demand for approximately 21,000 boxes a day in sales. One of the keys to SIMonics' profit margins is cost containment. Product costs are kept low by keeping the ingredients in each cereal balanced. This low degree of differentiation keeps raw material costs from having too much impact on our profit. In addition, when sufficient cash is available, we pay down our bank loan in order to reduce our fixed costs, which help us to maintain our profit margins. Finally, in order to contain costs, we carefully manage our inventory. For example, if inventory exceeds 200,000 units of finished goods, then we reduce production, increase marketing, or reduce prices. If finished goods inventory falls below 100,000 units, then we increase forecasts to produce more finished goods, which allows us to maintain enough inventory to meet our buyers' demand. We use our marketing budget to increase demand in regions where the potential for sales are the greatest, and we do this for products that are already in inventory. For example, if 500 gram strawberry and 500 gram original muesli are not selling well and taking up inventory, then we may focus our marketing budget on the regions with the most DC-14 independent grocers to get the best return on our investment. We also keep our pricing competitive by tracking the average market price for our products. Competitive pricing is balanced against the need for profitability. To determine our prices, we make sure that there is an appropriate profit above our cost. SIMonics acknowledges the risks of a diminishing operational advantage over time as the muesli industry matures. To offset these risks, SIMonics plans to adjust production capacity and setup time as necessary to meet changing demand. We also will substitute or adjust the mix of materials or the timing of the purchase of raw materials. And we will maintain our long-term strategy regardless of short-term changes to the market, such as competitors dumping product at low price. Product mix is important to maintaining profitability. It should represent our customers' desires while also maximizing any market opportunities. In the fourth quarter, we eliminated lower performing 1 kilogram blueberry and replaced it with 1 kilogram raisin, which no other competitor was producing at the time. And the raisin became our top selling item for the sixth quarter. In addition, in the sixth quarter, we shifted away from 1 kilogram nut and switched to 500 gram nut with an increased percentage of nuts in the product's design. This resulted in our ability to command a larger profit margin in nut cereal. How does SIMonics make their product mix decisions? We strategically determine our product mix based on market performance and profit margins. For example, during the fourth quarter, when we switched from 1 kilogram blueberry to 1 kilogram raisin, we had noted that the 1 kilogram blueberry was producing the lowest net profit. This information, combined with the lack of competition in raisin, resulted in our decision to switch. The chart illustrates the company's market share by total boxes sold for each of the products during the sixth quarter. Overall, SIMonics averaged 28% market share during the sixth quarter. SIMonics had a commanding 100% market share in 1 kilogram raisin and a low market share of 12% in 500 gram original. In conclusion, SIMonics is the #1 ranked company in the German muesli industry out of 9 companies. Our strategy of operational excellence gets bottom line results and has the best return on investment of all muesli competitors. We have strategy in place to continue successfully into future quarters and have planned for potential risks. For these reasons, the board should reaffirm their support of our venture. Now we will transition to the presentation for our section coordinator. Welcome, Rami. During the course of running the ERP software, we have learned the difficulties of maintaining finished goods in inventory. We tried small production runs, found them to be inefficient, and inevitably learned to effectively use 50,000 unit production runs with only 2 to 3 runs in queue so that we did not run out of inventory as customer demand changed. Dips and spikes in the sales cycle were hard to deal with in the beginning. We often reacted by focusing solely on prices, which made forecasting and inventory management chaotic. Eventually we came up with more strategic actions to take, such as producing a cereal like raisin once we realized no other company was producing it, or changing the mix in our cereals to differentiate them, such as adding more nuts. We also learned about the drawbacks of sole source supplier contracts. In the game you could see how having only one supplier for a raw material led to risk of interruption or delay and dictated raw material prices. We learned to become patient and stick with our strategy through fluctuations in availability and price of materials. We also learned other ways to manage the situation, such as increasing prices and reducing production when a raw material was too expensive. The overall lesson we took away from the simulation was to stay patient and act strategically. We appreciate your help navigating the simulation. Thank you for your time, Rami.